It's a whole new world, but has anything truly changed? This is Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard, Glenn Hubbard of Columbia, and Ann Sonders of Charles Schwab. Former Secretary of Commerce Penny Pritzker.
Actually, the marketplace is driving this, and frankly, the government is catching up.
Former FDIC Chair Sheila Bair.
You need to go big right now. The economy is still in serious trouble.
And Council on Foreign Relations President Richard Haass. The United States got a new president this week in an inauguration unlike any other, with 25,000 National Guard troops called in for security, and hardly anyone in the audience kept away because of COVID. But it was more than just a change in administration. It was a change in philosophy and tone and approach.
Politics doesn't have to be a raging fire, destroying everything in its path. Every disagreement doesn't have to be a cause for total war.
And signs of a change in direction as well, as President Biden issued 15 executive orders on his very first day, undoing a wide range of his predecessor's policies. But with all the talk of change, how much is really different? This week, we also had the new president's nominee for Treasury Secretary Janet Yellen testifying at her confirmation hearing about just how bad the economy still is, asking Congress to do a lot more to keep us going before we can even think about rebuilding.
When economists look back on the pandemic, I expect they'll conclude that Congress's actions averted a lot of suffering. But more must be done.
And on the day before President Biden took office, the country passed the mark of 400,000 people dead from COVID-19, even as states continue to struggle to get vaccines into people's arms. In Europe, the ECB pointed to the possibility of a double-dip recession, but kept its pandemic bond-buying program steady at 1.85 trillion euros, betting on stimulus to counteract the crippling effects of extended lockdowns in countries like Germany, but saying it will take another look in March when it has more data. So how did the markets process all this talk of change and all the staying the same? Well, equity spent 4 days moving up on hopes of the new Biden administration and the promise of vaccinations, only to have some second thoughts at the very end of the week. But still, overall, the S&P was up by 2%, and the NASDAQ had its best week since early November. The drivers, though, had more to do with staying at home than getting back to normal, as sectors like communications, tech, and consumer discretionary led the way, and materials, financials, and energy trailed. Bonds didn't really move much of anywhere, commodities were mixed, and the dollar continued to weaken. To help us see things the way the markets, and for that matter, those who invest in the markets do, we welcome now Ann Sonders. She is Charles Schwab Chief Investment Strategist. Ann, always great to have you with us on Wall Street Week. Thank you for being here. Give us the perspective. What did the markets see this week, and how did they react to it?
So I think what the market has seen really in the last couple of weeks is a change in the near-term trajectory of the economy. And you can really go back to the early September time period, up until which we had seen such dominance by the big five names, that concentration in parts of the market that were seen as the only COVID beneficiaries. And at that time in early September, there was more than a 60 percentage point spread between the big five and the entire rest of the S&P. Then these series of rotations started. It really kicked into high gear in early November, out into areas that hadn't worked, into much more traditionally cyclical areas because of the vaccine and pun intended, the shot in the arm that meant for the economy. But then by virtue of the virus and seeing the weaker economic data, retail sales, the December jobs report, I think we've seen this reversion back to those kind of stay-at-home stocks, what have been this era's defensive stocks. And I think that helps explain what has been this ongoing conundrum or question about the perceived disconnect between the market and the economy. Looking under the hood of the market, those rotations, I think, do reflect what's been going on in the economy.
So take us forward to next week. We've got a lot of big tech earnings out. Is tech fully valued at this point? What are you expecting? Will there be a continued move into tech?
It depends on what tech you're talking about. I think there are some, extraordinarily expensive names within tech. We have a market perform rating on tech, which means sort of stay in line with market levels. We think it's probably a little rich broadly from a valuation perspective to kind of press bets on the outperform side, nor do we think you want to be underexposed, because that's really where the growth drivers are. I just think in this environment, whether it's within tech or other sectors, be them on the growth side of the spectrum or the value side of the spectrum, I think what's going to work in this market is actually a bit of a hybrid approach, almost what we used to call GARP, where you want companies that have those growth characteristics, strong balance sheets in addition to that, but you're not paying nosebleed valuations for them. And I think that blended strategy within tech, but in other areas, is going to serve investors well this year.
Lizanne, how much froth do you think there is in the market? We had Jeremy Grantham tell Bloomberg this week he thinks this is the worst bubble since 1929. And he's something of a perma-bear, but at the same time, you've got Bitcoin all over the place, shooting up over 40,000 and dropping back off. And you also had at the very end of the week a remarkable circumstance with GameStop shooting up on basically retail investors, as far as I can tell, buying calls.
I think there are micro bubbles, and they're a function of the newly minted day traders, the retail traders, as you talk about, and the fact that they sort of move in and out of certain pockets of the market, be it in cryptocurrencies, certainly in call options, naked call options. Until a couple of days ago, you were seeing the best performing stocks being less than $1 at the start of the year. So there's also been this trend to not cheap stocks from a valuation perspective, but low price stocks. But I think it's a function of that rotation, and you can see some of these micro bubbles actually get pricked and some of the air come out without taking the entire market down with it. So that, I think, is the differentiator between an environment like today versus, say, 1999, 2000, where the bubble was in the most dominant names, in the most dominant indexes, the S&P and the NASDAQ. And that's why when that bubble burst, it did take the market down with it. I think we could continue this process of rotational corrections that maybe hopefully eases some of this speculative fervor. That doesn't mean it's not going to find another place to go, but may not be the kind of systemic thing we think about when we go back to, say, circa 2000.
I wonder, Lizanne, if that takes us back to the earnings question in some sense, because you've contrasted 1999, 2000 in a situation where both price and earnings were going up. This time, earnings still have a while to come back. Do you expecting earnings to really rebound here over the next year or so?
Well, and that is the difference, because earnings and prices were moving up in 2000. It's just prices were moving up at a much more rapid pace. And we now know, with the benefit of hindsight, earnings were rising into a peak. Clearly, what at least initially drove the PE to shoot up was the collapse in earnings. Now we're looking at an upswing into earnings. So far, if we look at the pattern from second quarter, third quarter, and so far in fourth quarter of record beat rates, that could mean that the estimates that are in place for 2021, which really start to kick into higher gear in the second quarter, simply because the comps get easy. You're talking about year over year relative to the lockdown, the shutdown phase during the pandemic. Yeah. I think there's a risk in turn if those estimates prove to be too high, but there may actually be an opportunity for a better improvement to valuation if those numbers are too low.
Ann Sonders at Charles Schwab, always great to have you with us. Thank you very much, Lizanne. Coming up, what the Biden administration means for the economy and for business, from two women who helped manage the way through the last economic crisis. Sheila Bair, who ran the FDIC, and Penny Pritzker, who ran the Commerce Department.
I think there's some inequities of the past being addressed with these payments.
I think the issue of taxes is not front and center right now.
This is Wall Street Week on Bloomberg. President Biden's pick for Treasury Secretary Janet Yellen was one of the first of his cabinet nominees to have a confirmation hearing. In her 3-hour testimony to the Senate Finance Committee, the former Fed chair pressed President Biden's $1.9 trillion fiscal stimulus package as essential to fight the economic harm being done by the coronavirus.
Neither the president-elect nor I proposed this relief package without an appreciation for the country's debt burden. Members of the committee, these are very ambitious goals, and I know we will need to work together.
Yellen's support for the president's stimulus plan met some resistance from Republican lawmakers who expressed concern that the level of spending on top of what has come already could hurt rather than help.
But the $1.9 trillion package that has been presented to us is a package that focuses on some priorities that I think will actually hurt our economy as much as it would improve our economy.
Yellen also showed some potential continuity with some Trump administration policies, particularly in her tough stance on China, which she called the United States' most important strategic competitor.
We need to take on China's abusive, unfair, and illegal practices.
But the Treasury Secretary nominee did not condone Trump administration suggestions that the country might benefit from a weaker dollar, saying that should be left strictly to the markets.
What I'm concerned about is we seem to have no concern now about borrowing money in the short term. And the argument is that interest rates are low. It's like free money.
The world has changed. In a very low interest rate environment like we're in, what we're seeing is that even though the amount of debt relative to the economy has gone up, the interest burden hasn't. Over the longer term, I would agree with you that the long-term fiscal trajectory is a cause for concern.
It's been only a dozen years since Congress had to bail out the economy from the great financial crisis, and Sheila Bair was a key official in that rescue effort as head of the Federal Deposit Insurance Corporation. She says there will come a time to be frugal, but it is not now.
You need to go big right now. The economy is still in serious trouble, and once again, the people are getting hit the hardest are low income, low middle income families, and the lion's share of the assistance. You've got supplemental unemployment, you've got direct household payments. I think that's money well targeted and needs to be spent. Families need help; they're still struggling, and so I agree with her.
Targeting. We talk about targeting a lot. The Republicans talk about it.
Right.
We never seem to quite get there. I mean, as a practical matter, even with the PPE and things like that, it appears that it's going to the top, not the bottom. What can we do better to make sure it does get to the people who need it?
Well, I think the shift to fiscal away from monetary policy is hugely important. Notably, this $1.9 trillion does not include additional money to, backstop the Fed with its interventions. The Fed's just not equipped to get money to Main Street. They put money into financial markets. Wall Street's been doing really, really well since the great financial crisis. Not so much for that lower 80%, really, the people who work for a living and rely on labor income, non-investment income to live. So just shifting back to fiscal, that's a much better approach to get money actually in the hands of families. And, direct payments is a very efficient way to get money out quickly, which is really what we need to do. You don't need a lot of bureaucracy. There's there's all this debate about whether people earn it or not or deserve it. I look at all the trades that have gone to Wall Street, and I kind of have disdain for that. The lower 80% of the population, which is where these payments will reach, they've not done so well. All right, it took them 10 years to recover. They were finally just catching up, and we have this hit. So I think there's some inequities of the past being addressed with these payments as well. But at least we know where the money's going. It's going to households. They can spend it on consumption, they can pay rent, they can pay their bills, they can save some of it, they can buttress their emergency savings. Again, I think that's money well spent.
So one of the things that you focused on during the great financial crisis was really the safety and security of our financial systems. As we go through this crisis and you look from the outside now, do you see places that you're concerned about the financial system?
I do. I think the unbanked sector, the non-bank sector is a continuing source of turmoil. And last March, we had market disruptions. Same suspects, right? Money market funds, highly leveraged hedge funds, levered corporate ETFs. The Fed, again, had to come in and provide a lot of liquidity, a lot of bailouts. Whether that was right or not, I don't know. I do know that when we resort to bailouts as opposed to using regulation to prevent these unstable structures to begin with, we just reinforce risky, bad behavior. So we need to fish or cut bait, stop the bailouts, let them go down, let the market punish them, do away with them, or start providing some meaningful prudential supervision to prevent these unstable structures from proliferating. Maybe some combination of both, but the unbanked sector, non-bank sector is definitely an area of continued financial fragility. And I think, again, Janet Yellen, as chair of the Financial Stability Oversight Council, which has the authority, the cross-cutting regulatory authority to deal with this, this, I hope, will be a high priority for her as well.
That was Sheila Bair, former FDIC chair. The Biden administration will take a decidedly different approach to regulation from that of President Trump. But Penny Pritzker, President Obama's Secretary of Commerce, says when it comes to the environment, the regulations are lagging behind where business has already taken us.
The regulatory picture will be encouraging that, as opposed to something that's just trying to create regulation for regulation's standpoint.
At the same time, could it curtail growth, do you think?
No. I think that focus on climate and clean energy and electric vehicles, et cetera, is about leading for the future. You're seeing demand for that. Look at the valuations of the companies, the car companies that are leading in electric vehicles. The market is telling us this is where they want to go. The consumer is telling us this is what I want. And so I think this is about leading as opposed to fighting to preserve our totally fossil fuel based economy. That is, we're going to have a hybrid economy in that respect. We've got to continue to move for the sake of our planet towards cleaner and cleaner energy consumption and a better climate policy.
One of the things that we are anticipating is that there will be more requirements for disclosure by corporations on things like the effect on the environment and other issues involving what is typically talked about as environmental, social, and governance, ESG sorts of issues. Do you think that will actually change investment patterns? As an investor, as a shrewd businesswoman, do you think it would change investment patterns?
Well, I think investment patterns are changing. My experience in my own corporate life, both on boards and in businesses we own, is our workforce is demanding that we change the way we do business. Our stakeholders are demanding that we change the way we do business, that we're more sensitive in terms of the way we do governance, that we're more sensitive to sustainability, that we set goals for ourselves around diversity so that we are able to behave to a set of standards that are living up to the values that are everyone involved in a business, whether it's your employee base, your customer base, your supply chain demands of you. So I think that actually the marketplace is driving this, and frankly, the government is catching up.
One of the things that we heard in Janet Yellen's testimony for her confirmation was a lot of questions about taxation, particularly coming from the Republican side. And of course, President-elect Biden, when he was running, and he will be president, had a lot of proposals on taxation. How nervous is American business about increased taxes?
I think that American business is focused right now on solving the crisis, the virus crisis, that we need to get everyone vaccinated, and that we need to make that a transparent and reliable process, which I have every confidence that the team that President-elect Biden has put together will be able to do. I think number two, they recognize we've got to help small and medium-sized businesses. We've got to get the service industries back in order, and I think and functioning, and get people traveling again. That's such an important part of our economy. And then I think there will be a focus on infrastructure. So I think the issue of taxes is not front and center right now. I think what's on the mind of American business is really we need to get over the hump and over the hurdle of conquering this virus.
That was Penny Pritzker, founder of PSP Partners and former Secretary of Commerce. Coming up, President Biden takes the first steps toward rebuilding international alliances. And Richard Haass, president of the Council on Foreign Relations, says there's a lot to do.
At the back of every ally's head is the concern over whether this divided country can be there for them.
This is Wall Street Week on Bloomberg.
I, John Fitzgerald Kennedy, do solemnly swear.
I, Lyndon Baines Johnson, do solemnly swear.
I, George Walker Bush, do solemnly swear.
That I will
execute the office of President to the United States faithfully.
That I will execute
faithfully the office of President of the United States.
The office of President of the United States faithfully.
That I will faithfully execute
the office of President of the United States.
The office of President of the United States.
That was a glimpse of inaugurations past. This inauguration was like no other, without the hundreds of thousands of people on the Mall because of COVID-19, but with 25,000 National Guardsmen occupying the Capitol to prevent a repeat of the riots from 2 weeks before. It did share with earlier inaugurations the attention of the entire world. And Richard Haass, president of the Council on Foreign Relations, thinks President Biden used it to start to rebuild alliances that had suffered under his predecessor.
This projected an image of a very familiar, reassuring America, bipartisan, calm, resolute, and I think this is all good, but it will take time. I think at the back of every ally's head is the concern over whether this divided country can be there for them, and also what comes in 4 years. And to put it bluntly, how are they to understand where America is in the arc of its history? Were the last 4 years the aberration, and this is now the restoration of the normal? Or will it turn out that the last 4 years were a harbinger? We'll have 4 years of Joe Biden, but then we're going to return to some version of Trumpism with or without the man. And that's the question mark that Mr. Trump planted around the world.
Richard, I wonder if there's one place in which we shouldn't really expect too much of a deviation, because we did hear in the confirmation testimony from Tony Blinken, and he seemed to indicate maybe they would be just as tough on China as President Trump had been. And by the way, Janet Yellen, the nominee for Treasury, also had some harsh things to say about China.
Oh, I think there'll be more consistency than difference there, David. You're exactly right. I think it reflects a shift in American thinking about China. It's a bipartisan shift. Much more critical, much more skeptical. But this is a very different China. This is Xi Jinping's China. It's more repressive at home. Economically, it's not evolved in ways that people expected or hoped for. It's stronger militarily. It's much more assertive diplomatically. So I think you're going to get much more pushback from the United States.
So, Richard, to borrow a hackneyed expression from an old car commercial, as I recall, this ain't your father's world anymore. I mean, what gave rise to the post-World War II structures doesn't obtain anymore. So it's not just a matter of going backward, right? It has to go forward. Is there a vision? Does the Biden camp have a vision of how we can rebuild better?
That's a great question, David, and the answer is not yet. So I think the initial thrust of the administration would be what I would describe as repair. The things we've just been talking about, to stabilize the home front, to get the United States back on the playing field of international organizations and diplomacy, to revive alliances. And then you've got the heavy lifting. What will the United States do vis-a-vis Russia and China to manage those great power rivals? What will we actually do on climate? Can we structure the digital space, which is clearly essentially the Wild West? What can we do so the world is better prepared for the next pandemic and is better able to deal with the existing one? So I think that's, there's a little bit of time there. That's why you got to get everybody up to speed in their jobs, got to get the interagency system working. But I think the idea of innovation, of moving forward, we're not going to know that for a few months, but that'll be the ultimate test of this administration's foreign policy.
That was Richard Haass, president of the Council on Foreign Relations and author of the best-selling book, The World, A Brief History. Coming up, President Biden wants to increase the federal minimum wage to $15 an hour. But what would that do for the economy? And what's it got to do with the pandemic? We asked contributors Larry Summers of Harvard and Glenn Hubbard of Columbia. This is Wall Street Week on Bloomberg. President Biden wants to raise the federal minimum wage to $15 an hour, a measure he included in his day one priority of passing a stimulus bill to support the economy.
People in both parties now recognize it's time to raise the minimum wage so hardworking people earn at least $15 an hour minimum.
A move to $15 an hour would be more than double the current minimum wage of $7.25, which hasn't been changed since 2009. If passed, it would provide a pay hike to nearly 400,000 Americans who are earning minimum wage.
The $15 minimum wage basically gets you to the poverty line for a family of four.
Until now, it's been the states leading the charge in raising minimum wages, with 29 states and the District of Columbia already taking action.
All of the evidence historically is that the economy rose after the minimum wage has been raised. It is not the burden that it has been sort of told.
Critics say that raising the minimum wage could come at the cost of millions of jobs.
One thing that even the Congressional Budget Office recognizes is that by increasing the minimum wage to $15 an hour, it could shutter somewhere around 3.7 million jobs on the high end, a minimum of 1.3 million jobs in our economy.
One of those critics is Walmart CEO Doug McMillon. At a Business Roundtable event this week, the CEO agreed that $7.25 an hour is too low, but called for a higher wage that takes into account geographic differences and small businesses.
I think that the CEO of Walmart is making a sensible statement that one size fits all isn't perfect.
Some CEOs, like some states, are not waiting for the federal government to raise wages for workers.
No matter what happens on the government level, on federal level, or the state level, we have companies, and I see the signs, and I see companies are coming forward. We have to do what's right, which is bring the minimum wage at least $15 to start with.
Regional differences in the cost of living and the timing of a potential hike in the minimum wage raises concerns with some economists.
I don't think it belongs in here. It's not stimulus, it's not relief. It gets in the way of recovery in the labor market, and so I expect that to drop out.
Our roundtable reaction to a rise in the minimum wage. We welcome now Wall Street Week contributors Larry Summers, who served as Treasury Secretary under President Clinton and then as Director of the National Economic Council under President Obama, and Glenn Hubbard, who chaired the Council of Economic Advisors under President George W. Bush. Welcome to both of you. Larry, let's start with you. What would be the effects on the economy overall of a rise to $15 an hour for the minimum wage? I read from the CBO, from the Congressional Budget Office, that on the one hand, you'd lose 1.3 million jobs. On the other hand, you'd take a lot of people out of poverty.
I think you would take a lot of people out of poverty. I think on balance, it's probably positive. I worry less about job destruction than I worry that employers will stop paying benefits when they have to pay higher wages. I worry that employers will shift away from the most vulnerable and inexperienced workers towards workers with more experience and more education. And so I think I'd probably prefer to see a more gradual approach and a more differentiated approach to a major minimum wage increase. But if we're going to have a minimum wage, the question is whether to do this or to do nothing. I would, on balance, favor doing this.
So, Glenn, is there a third alternative to address perhaps some of what Larry is concerned about? I've heard it suggested that the problem with the minimum wage is it essentially acts as a tax on the employer. A better way would be to get money into the hands of people who need it through increasing the earned income tax credit, because that's a tax on all of us. It's shared equally. It doesn't penalize you for employing people.
Well, I think that's right. I think President Biden got it right when he said people who work 40 hours a week should not be poor. That's a moral statement. It's an economic statement, but it's not a comment on the minimum wage per se. I would think that the EITC increase, particularly for childless workers who have not received much work support from EITC, and President Biden has talked about that, and also big government support for training, for community colleges. These are the kinds of things that could help raise the wages of low-wage workers. So a gradual increase in the minimum wage may, on balance, be fine if it's gradual and not all the way so fast. But I think building bridges to the future for workers is a much better idea.
So, Larry, what about it? Would you prefer an EITC increase, or is that just not doable? When you were in the halls of government, did you think about that?
Sure, I would. And Biden has, the president has talked about increasing the minimum wage, increasing the EITC. He's talked about increasing the child care credit, everything that's pro-training that Glenn talks about, I'm for. I'd go a little further than Glenn. We've left the minimum wage where it is for 11 years since 2009. So I think a bit of a jump increase now, not all the way to $15, would probably be well advised. I think embracing the principle that no head of household or no independent adult who works full time should be below the poverty line. And then the question is, who do we put that burden on? I don't think we'll decide that it should all be put on employers who employ low-wage workers. If we frame the problem that way, I think Glenn and I are pretty much in agreement on that. I think what people tend to forget when they think about the minimum wage is that a lot of the beneficiaries are people working after high school and the like, who don't have quite the same economic need, and who, for whom there may be more risks that it causes the job to have the training elements taken out. If an employer can only afford to spend so much on a worker, it might be that both sides like it better if some of that is training, some of that is health support. And if you move it to a minimum wage, it will all be just wage support. So I'm pretty much in agreement with Glenn. But let's understand that the really fundamental thing we need to do is to declare the principle that people who work full time shouldn't be in poverty.
Yeah.
If we can make that commitment as a country, then we can debate what the right tactics are. And a lot of the debate about the minimum wage, frankly, is that some people want to make that commitment as a country and others don't. And I have much more time for those like Glenn who support that commitment, but just don't want to just have differing views as to how it should be achieved.
So I found agreement on the roundtable, more or less, about the minimum wage. Let's see if I can find some disagreement. Let's talk about the deficit. We heard from Janet Yellen in a different capacity this week, testifying before the Senate Finance Committee as part of her confirmation hearings to be the next Treasury Secretary. And one of the things she said was, we really have to step up. We have to borrow money and invest in the economy. But at the same time, I'm very conscious, and the president's very conscious, of the level of debt. My question basically to you, Glenn, because Larry has sort of answered it, is, does the deficit matter? As you know, he wrote a paper with Jason Furman late last year saying, you know what, given where we have structural interest rates, we shouldn't be really worried about the deficit at all, should we?
Well, I think we should, but not at this particular moment. We're fighting a war. It's called the pandemic. And I agree with Treasury Secretary Yellen that we really need to fight it. I may not agree with everything in President Biden's package, but a major effort is going to be important. I do think, though, going forward, if we're going to start new programs, we would need to pay for those programs. I do take Larry's point that as long as debt service burdens are modest, that's important. And if we have low interest rates and low debt service burdens, that may mean we can have a higher debt. But sustainability is a different question from smart. So if we're borrowing money, what are we using it for? If it's to fight a war, if it's for infrastructure, if it's for shoring up important elements of the country, that's one thing. But as a substitute for spending we're not paying for, that makes me more nervous. Okay,
so I may have stumbled across some agreement here too, Larry. Correct me if I'm wrong, because in your paper you talk about balanced budget multipliers. Made me go back to the dictionary, understand what that is. As I understand, that's sort of saying make sure you spend it in a way that's actually going to grow the economy.
I think Glenn and I are pretty much in agreement here on the principles that you have to pay attention to the level of the interest rate, and lower interest rates enable larger deficits. And I think the most important thing we're in agreement on is the basic economic fundamental that borrowing money is neither good nor bad. It depends on what you use the proceeds for. and we ought to be using the proceeds for investments that have high return. And if we borrow in order to generate investments that have return higher than our borrowing costs, that increases and improves our long-run economic position rather than makes it worse. So we've got another sort of bipartisan agreement going on here. And I suspect that Glenn and I share the view that what's going to be really important as we are responding during this pandemic period is that we recognize that we don't have infinite resources, and that the three main uses need to be vaccines and anything else that will get us past the COVID pandemic as rapidly as possible, supporting people who are truly vulnerable and are being hurt, and as the president has said, building back better with major new productive public investments. And probably a much lower priority should be on generalized distribution of purchasing power, which probably corresponds to a problem that we don't really have, that the main limitations have to do with the fact that people can't go out and eat, can't take vacations and the like, not a generalized lack of purchasing power. We need to focus on the specific lacks of purchasing power of the people who are poor.
Yeah, exactly. The purchasing power actually has been going up to a large degree, and we got a lot more savings going on. Okay, Larry Summers and Glenn Hubbard will be staying with us, as we're going to turn our attention to the global economy and what needs to be done to ensure global economic growth. That's coming up next on Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. The European Central Bank met this week, and although it didn't surprise anyone in what it did, President Christine Lagarde did warn of the possibility of a double-dip recession in Europe as a result of further shutdowns triggered by the pandemic. And reinforcing Madame Lagarde's warning were PMI numbers showing further contracting in Eurozone and UK business activity in the month of January. We turn once again to our roundtable for a reaction to what we're seeing in continued European economic softness. So, Glenn, I'll start with you. Is there anything that Madame Lagarde, or for that matter, fiscally, they can do over there? Is this all a matter of vaccinating people?
Well, it's first and foremost a public health crisis, and vaccination is important, and all of the prophylactics to fight the spread of the disease. But there are fiscal policy actions that need to be taken to sustain workers, to sustain firms during this period, so that you don't have a K-shaped recovery as the vaccine finally comes aboard. So I think for Europe, fiscal policy is going to be more important than just asking President Lagarde to do her job.
So Larry, talking about a K-shaped recovery, I wonder if there's a different kind of K-shaped recovery. If you take a look at China, China seems to be rebounding quite nicely, if we can say that about the pandemic. Europe is really struggling. Maybe the U.S. is somewhere in between. Are we seeing a really divergence among the nations right now in recovering their economies from the pandemic?
I think we are, David, and I think ultimately what historians may notice out of this moment is how much better Asia did than the West did. And the order of magnitude, and I mean that literally, by more than a factor of 10, in some cases by more than a factor of 100, differences in performance between Asia, large parts of Asia, and large parts of the West. That's something that goes beyond Donald Trump versus somebody else as the head of state. And I think that's something that's going to get a lot of attention going forward. And I think that it's why, in addition to the human issues, what President Biden's able to do in the next 3 months is going to be so profoundly important. If there was ever a test of whether government by the people was effectively government for the people, it's in the ability to protect people from a pandemic. And right now, the democracies of the United States and Europe are not looking particularly good relative to more authoritarian states? And I think that's a very profound question going forward.
Glenn, do you agree with that? And if so, do you have a hypothesis about why there is that divergence?
Well, I think it differs across countries, but I think Larry's right. We do need to make sure that democracy is capable of coping with these major mobilization type challenges we have before, and we can do it again. I would also worry about emerging economies. We've been talking about industrial economies, Europe, China, United States, but the emerging economies have huge problems, both in public health and in economics, and require our attention too.
Okay, we wrap up every week with a quick summer says around here with Larry Summers about what he thinks about various things. Let's start with 100 vaccinations in 100 days, which is what President Biden is committed to. Is that going to happen or not, Larry?
He's going to overperform significantly on that promise. We're almost at 1 million a day, and there's every reason to believe we can ramp up in the future. We will do substantially better than 100 million vaccines in 100 days.
Let's talk about the U.S. Treasuries. We heard from Janet Yellen again at her confirmation hearing. They're considering at least the duration. Are we going to have a 50-year U.S. Treasury bond before the Biden administration is over?
That's a long time. We're not going to have it anytime soon because Janet's going to learn what all her predecessors who thought about this learned, that doing that would be a major gift to all the fixed income trading desks and all the hedge funds at the expense of taxpayers. Given the way it's likely to be priced, it would turn out to be a major setup for arbitrage opportunity. So it won't happen anytime soon.
And finally, Larry, we had a remarkable development right at the very end of the week. It was a company named GameStop that they actually had to stop trading twice during the day. It shot way up, I mean, way up. And apparently it was because there was sort of an army of Reddit users who all marshaled together to go against a short seller. And basically, I couldn't see any change in the underlying company at all. Is social media going to really do damage not only to our political system, but to our market system?
I suspect our market system will survive social media, but God, this points up the need for, as we used to say in the Treasury in the 90s, a regulatory system as modern as the markets. And there's always a need to regulate bucket shops and to regulate various ways in which retail investors are taken advantage of. And we're in a situation where it's an old theme and an old story, but there are new ways of doing it. So I'm glad that we're having an administration and a set of financial regulators. I was glad about the appointment of people like Michael Barr at the controller of the currency, Gary Gensler at the SEC, that will be committed to regulating where regulation is necessary.
But Larry, briefly here at the end, I must say I'm surprised. I thought if there was going to be a regulatory body with respect to social media, it would be the FTC. It could be maybe Department of Justice and Antitrust. Maybe it'll be the SEC, actually, that has to regulate social media.
Look, I think there are a whole set of issues that are outside my expertise on, inflammatory tweets, on monopoly power in social media platforms, in privacy issues that are the FTC's remit. But when I look at things like what happened at Reddit today, that's a kind of dysfunctional market. And I think that's something the SEC is going to have to pay a lot of attention to, just as there were a whole set of practices that produced balloon bubble stocks prior to 1929.
As I say, a really remarkable development. Really remarkable development. Thank you so much to Wall Street Week contributors Larry Summers of Harvard and also Glenn Hubbard of Columbia. Coming up, defending the commander-in-chief from cyber attacks on his exercise routine. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now for a look ahead on global Wall Street.
David, next week brings us a virtual Davos, and we will hear from more government and corporate leaders on the global outlook with Joe Biden in the White House. And here in Asia, we have a busy week of earnings ahead. From Japan, more than 400 companies listed on the topics report, including prominent tech players Fanuc and Tokyo Electron, along with Tokyo Disney operator Oriental Land. South Korea's lineup includes Hyundai Motors and Tesla battery supplier LG Chemical. And we'll also get results from India's largest lender, the State Bank of India, which will give us clues into the recovery ahead of the Indian Parliament kicking off its budget session on Friday. Danny?
Thanks, Sophie. In Europe, there are increasing fears about a double-dip recession. We got data on Friday that showed the economy in the euro area is slipping further into a contraction. You have more lockdowns hurting the services sector, and at the same time, Brexit increasing delivery delays hurting the manufacturing sector. How the government responds to this over the next week is going to be crucial, and their plans on how much longer economies will continue to be locked down. Scarlett?
Thanks, Danny. Week 2 of Joe Biden's presidency may bring more executive orders and updates on his $1.9 trillion COVID relief plan. The pandemic has generally been a big positive for tech, and their latest earnings report will likely show the spoils. Industry giants Apple, Facebook, and Microsoft all expected to indicate that the trend will continue well into 2021. The Federal Reserve holds a 2-day meeting. Chairman Jay Powell expected to stress the need to wait and see on how fiscal support and the vaccine rollout shape up before making any changes to its outlook. And we get an initial read on fourth quarter economic growth, with GDP probably slowing to a 4.3% rate. David, back over to you.
Thanks to Sophie, Danny, and Scarlett. Finally, one more thought. It's not easy being president. You have the weight of the free world on your shoulders. You have a pesky Congress that gives you a tough time over just about anything you want to do. And you need to protect the country from possible attack at any time of day or of night. But the job is not without its perks. You get a big house, you get a 747 as your personal airplane, and a limo so big that they call it the Beast. And of course, you do have 4 million employees committed to giving you anything you want, right? Well, not so fast. It turns out that all those people charged with keeping you safe have their own ideas about what you can and cannot do. So when President Barack Obama took office, he fought for 2 months to keep his BlackBerry. Sure, he ultimately got his way, but only after a 2-month battle, and when he got his precious BlackBerry back, he could only reach a small circle of people, and even those couldn't forward any of his messages. And now it's President Biden's turn. His simple pleasure is getting on his Peloton and working out every morning to get the day started right. But there is a problem. The Peloton connects to the internet, letting you get inspiration from your favorite trainer and compete with others on the leaderboard. Well, the Secret Service is none too happy with the idea of foreign adversaries getting access into the new president's innermost sanctum, not to mention his exercise routine. I'm sure President Biden will get some version of his beloved Peloton back at some point, but we should all take heart that even though we can't protect untold government computer systems from Russian hackers, we can make sure they can't get at one lonely Peloton now located at 1600 Pennsylvania Avenue. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.